Morning, and you probably consume their products every day or over the weekend. Well, you could also make some money while you're swigging that Carlsberg or Foster's. Shares of the biggest beer makers are now a buy. So say the majority of analysts that we track. We crunch the numbers for you, comparing their target prices versus their latest closes. All but one of the beverage stocks show upside potential. In fact, Australia Foster's has a biggest potential gain of as much as 9%. So things are indeed looking up for makers of alcoholic beverages. And Molson Coors, well, they just reported second quarter profit that topped analyst estimates after it cut costs and also raised their beer prices. The company's beer brands, which include Blue Moon and Coors Light, of course, Molson Gold from Canada, it more than doubled its profit, and shares of Molson Coors that closed up 5% higher in New York trade. Over here in Asia, shares of Kweichow Moutai led gains by Chinese liquor makers on speculation that they will also raise prices. Moutai is China's biggest producer of spirits by market value, and investors are betting that it will follow its rivals such as Tuopai Yeast Liquor and raising prices by as much as 10% or more. Meantime, over in Japan, the country's top-selling beer maker Asahi Breweries said the first half profit rose 17%, helped by the sale of a stake in a Chinese beverage venture. Asahi may lose its position as Japan's top beer seller to Kirin Holdings later on this year. Domestic shipments of super dry and other beers have slipped 1% in the first half. Asahi is speeding up expansion overseas to try to offset the falling beer sales at home. The company has taken an almost 20% stake in China's Qingdao Brewery, a recognizable beer brand. Our next guest says that mergers and acquisitions may indeed be viable for Asahi and other Japanese brewers. You've got an aging population first in Japan, drinking less beer, and a market that has way too many products on the shelves. Let's welcome back Frederick Gits, a senior director at Fitch Ratings, to talk about the beer wars in Japan. Welcome back, Frederick. So first, let's talk about the possible Kirin Suntory deal. I mean, both recently this month admitting that they're in early stage discussions. But let me ask you, first off, is this deal a done deal?
Again, it's never a done deal because first they would have to negotiate how much the price they would have to pay, exactly what would be the terms of the deal. Yeah, we have to see, and then there are the issue of antitrust authorities, given that the market share of a combined Kirin Suntory as it stands now would be about 50% of the beer market, which is quite sizable. But so again, it's never a done deal until it's completed. But what we can say is that probably for the industry it would be a good thing if it happens.
Okay, well, let's break it down then. Talk about Kirin in particular, because as we mentioned, this company is set to become, I guess, Japan's biggest brewer by shipments. It has spent over $7 billion just in the past 2 years on expansion. But let me ask you if Kirin can actually really afford this. As you mentioned, maybe what they're spending right now is about 3 times EBITDA. And you said that if the Lion Nathan deal does go through, maybe you have to reduce Kirin's rating down, its credit rating down 1 notch.
Yes. Now, this said, the rating of Kirin is currently at A+, with rating watch negative, so it goes down by 1 notch, still an A flat rating, which is still pretty strong. Leverage would be, yes, that's true, relatively high, but this business is free cash flow generative, so this allows debt reduction, which is pretty quick. Now, the question of whether they can afford Suntory, it's a bit difficult to answer in the sense that is it going to be just simply a merger, share exchange with no cash outlay, and then in these circumstances, simply because the current debt of Suntory is not very different in terms of leverage than Kirin's, the overall leverage impact would not be that big, or is there going to be a significant cash outlay in the transaction? And this could make a big difference in terms of the rating of the combined entity.
Yeah, but what about Kirin's strategy? Does it make sense? Is this the way to go for Japanese beer makers, considering the problems that they're seeing in their own home market, which is to go out and buy other beer makers in the region or internationally?
I think it does make sense to go out of Japan and to try to grab shares in more growing markets. Now, the thing is, if you want to go outside of your domestic market, it's best first to clean the house in the domestic market as well, and to make it more profitable, simply because if you do so, you will have more firepower than to make acquisitions abroad. And that's true that currently the Japanese domestic market is comparatively not very profitable, and a merger of Kirin and Suntory would probably help make it more profitable, which would mean more cash flows and also more money to make acquisitions abroad. So I would say growing the domestic market, or at least gaining market share in the domestic market, improving the pricing in the domestic market, making it less aggressively competitive would be a good thing also for expansions overseas.
Yeah, well, Frederick, let me show you the, I guess, the share price performance of Japanese beer makers this year so far. It's lagged other competitors in the region. That includes San Miguel, also Qingdao. Will Japanese beer makers continue to be underperformers here in the Asia Pac?
Equity-wise, again, I'm not the best person to comment on that, given I'm a credit analyst. But in terms of the performance, I would say that Kirin has been doing quite okay in the Japanese market. And if the merger does go through, I think that they would have a good potential to continue growing. And the one which is a bit, Sapporo and Asahi, then would be clearly under some more pressure because Asahi is weak in the third category market beer, which is the growing one in Japan, and they have a very strong position in regular beer, but regular beer is going down. Sapporo would risk being marginalized by a merger of Suntory and Kirin. So these ones really, the question is, what are they going to do if a Suntory and Kirin merger happens?
And what are they going to do? Do they have to merge? And will you maybe reduce your ratings outlook on these two breweries as well, with facing such a huge entity of Suntory and Kirin?
Because, again, the competition in the industry would probably reduce somewhat, and we would have a clear leader being able maybe to introduce more discipline in pricing. This could be good for the whole industry. So it's not necessarily negative, at least for Asahi. Now, the thing is that Asahi does have an issue that it's weak in the growing third category beer segment. It would have to face an entity with almost 60% market share. It's going to be very difficult for it. Now, do they have to merge? Probably not, but it could be a possibility.
It could be a possibility, always a possibility. Thank you for that. Frederick Gits of Fitch Ratings.